Welcome to the deep dive. Ever feel like you're just drowning in information? Articles, research, all those reports, and you just wish someone could cut through it all and just hand you the real core insights, those aha moments.
Absolutely.
Well, that's exactly what we're trying to do today. We're diving deep into this specific set of guidelines. It's called ISA 315, revised 2019.
Right.
And it's all about how auditors pinpoint and assess risks. We're talking risks of major errors in financial statements.
Yeah, the big stuff.
Now, hold on. Before you think, oh, this is just for accountants, stick with us. Seriously, the way these experts approach risk, it offers some really powerful ways for you to think about information.
It really does.
And maybe make better decisions in your own life. We found some, frankly, surprising details in our source material that'll make you think about risk completely differently.
Indeed. What's truly fascinating, I think, is how these standards give you a system, a structured way to spot potential problems.
Yeah.
Whether they're just honest mistakes or maybe, something a bit more deliberate.
Uh-huh.
So we'll be breaking down the key ideas of what's called audit risk, and we'll show how this newer approach to understanding a company's world, its environment, and its internal checks and balances helps auditors.
And us.
And by extension, helps all of us get a much clearer picture of, trustworthiness.
Okay, let's unpack this then. Let's get right into it. So our main theme today is risk assessment. When an auditor looks at a company's finances, what's their number one goal? What are they trying to achieve regarding risk?
Well, the primary objective, it's really to identify and then assess the risks of what we call material misstatement.
Okay, material misstatement, big errors.
Exactly. Big errors, big omissions, stuff that could actually mislead someone reading those financial statements.
Yeah.
And these misstatements, they could be from just genuine mistakes or sometimes, unfortunately, from fraud.
Right.
And this assessment, it happens on two levels. There's the big picture, the overall financial statement level, and then there's a more detailed level we call the assertion level. Once those risks are identified, that forms the basis, the foundation, for figuring out how to respond, what tests to run, what work needs doing.
And when you say assertions, are those the specific claims management makes? Like in the reports, we own this, we owe that.
Precisely. You've got it. Every number, every note in those financial statements is basically a claim, an assertion by management. Auditors need to get enough good evidence, appropriate evidence, to back up those claims.
Makes sense.
These assertions, they're the specific points where auditors focus their risk assessment. Because, if an assertion is wrong, that could easily lead to one of those big material misstatements.
Gotcha. Now, a lot of people might have heard about the classic audit risk model. It's almost like a fundamental law in auditing. How does that fit in with this revised standard we're talking about?
Yeah, the core model itself, that hasn't changed. It's still the bedrock equation. Audit risk equals inherent risk times control risk times detection risk.
Okay. Audit risk is IRX, CRX, DR. Still holds true.
Still holds true. Think of it like this. The overall risk that you, the auditor, might actually miss a big error. Well, that risk is a product of these three other risks.
Right. But our source material really emphasizes that while the formula is the same, how auditors evaluate these risks, that's seen a big shift, a big enhancement. That sounds really important. What's the key change there?
That's exactly the core of ISA 315 revised. It's not just asking auditors to spot risk anymore. It demands a much, much deeper understanding of the client's business.
Deeper.
Specifically, there's a much stronger requirement now to really get to grips with three key areas. First, the company itself and its whole environment, the market, competitors, regulations.
Okay.
Second, the specific accounting rules, the financial reporting framework it operates under.
Right.
And third, its system of internal control, all those checks and balances, this deeper understanding. That's what really informs how you evaluate inherent risk and control risk.
And I'm guessing these three areas, they link directly back to the parts of that risk model equation.
You're absolutely spot on. Understanding the entity and its environment, plus the accounting rules. That's vital for assessing inherent risk.
Yeah.
And getting a really thorough handle on the company's internal controls. That directly feeds into assessing control risk. It all connects.
Let's really zero in on that first one then. Inherent risk. It sounds like the kind of baseline vulnerability, like the risk that's there no matter what.
That's a good way to put it. Inherent risk is the susceptibility of one of those assertions, that claim about a transaction or an account balance to a material misstatement before you even consider any related controls.
Okay.
It's about the pure, raw vulnerability of that item itself. Think about trying to ship a delicate glass vase versus a solid rubber ball.
Right. The face is just naturally riskier.
Exactly. The glass face just has a much higher inherent risk of breaking no matter how carefully you try to pack it.
This is where it gets really, really interesting for me because the revised standard actually defines 5 specific inherent risk factors, things that make something more vulnerable. Can you walk us through those, maybe with examples we can relate to?
Absolutely. And these 5 factors are key to understanding why something might be inherently risky. So first up is complexity.
Okay.
This comes from just how intricate the information is, or maybe how complicated the process is to prepare it. In auditing, you might think of a huge global insurance company dealing with really complex financial instruments.
Yeah, that sounds complex.
In your own life, maybe it's like trying to assemble that piece of flat pack furniture with a massive instruction book and hundreds of parts.
Oh, I know that feeling. High inherent risk of leftover sprues.
Exactly. More parts, more steps, higher risk. Second factor.
The subjectivity.
Subjectivity. So judgment calls. Precisely. It comes from limits in how objectively you can prepare the information. An auditor sees this when valuing unique assets or choosing how to estimate something uncertain. For you, it's maybe like 2 different movie critics reviewing the same film.
They'll have different opinions.
Right. There's no single correct answer. Judgment introduces inherent risk. Third, change.
Change makes sense. Things shifting.
Yeah. Events or conditions affecting the business environment. Industry shifts, new regulations, economic downturns. A company going through huge customer changes, maybe expanding really fast into new countries.
Right.
Think about trying to navigate a city where they change the road layout every week. That constant change makes it inherently riskier to get where you're going without a mistake.
Okay, number 4.
Number 4 is uncertainty. This happens when you just can't prepare the information based on precise, complete data. Think of a company facing major ongoing lawsuits.
Hard to know the outcome.
Exactly. They have to estimate potential liabilities way before any verdict. For you, it's like planning a big outdoor party months in advance.
Yeah.
The weather forecast is just inherently uncertain that far out.
Right. Okay. And the last one.
The 5th one is susceptibility to management bias or other fraud risk factors.
Ah, the human element.
Kind of. It's about conditions that create an incentive or opportunity for management, intentionally or not, to not be neutral. Things like lots of transactions with related companies, heavy use of manual accounting adjustments, or maybe bonus plans tied directly to hitting financial targets.
Pressure points.
Exactly. In everyday life, it's like taking financial advice from someone who gets a commission based on what you buy. Their potential bias introduces a risk that the advice might not be purely in your best interest.
That really paints a clear picture. 5 key factors. And our source also mentioned a spectrum of inherent risk. What does that mean? And how does it connect to something called significant risk?
Okay, so for every potential misstatement risk they identify, auditors now have to do a separate assessment of inherent risk and control risk. That separation is new.
Okay.
The spectrum of inherent risk just means that inherent risk isn't black and white, yes or no. It varies. It can be low, medium, high, very high. It takes professional judgment to place it on that spectrum.
And why is that placing important?
It's crucial because it helps decide if a risk is a significant risk.
So a significant risk is one where that inherent risk assessment lands like way up high on the spectrum.
You got it. It's high because those inherent risk factors we just talked about, complexity, subjectivity, change, uncertainty, bias, they strongly affect both the chance of an error happening and how big that error might be.
And if it is a significant risk,
then the standard says the auditor has to get more persuasive evidence about it, more convincing proof. And they also have to specifically identify and check the controls the company has in place precisely for those high-risk areas. It flags it for special attention.
okay, that makes sense. You focus where the inherent danger is highest. So we've covered inherent risk, but you said companies can manage this risk, right? Which brings us to control risk. What's that about? And what does the revised standard say?
Right. Control risk is the risk that the company's own system of internal control, all their policies, procedures, checks, and balances won't actually prevent or detect and correct a misstatement quickly enough.
So the risk their safety net fails.
Basically, yes. Often it comes from controls being weak, badly designed, or maybe just not there at all. The revised standard now clearly lays out the different components of a company's internal control system, gives auditors a better framework to assess them.
What are some of those key components? What makes up that system?
It's pretty comprehensive. You got things like the overall control environment that's kind of the ethical tone at the top, management's attitude.
Culture matters.
Hugely. Then there's the company's own process for assessing its risks, how they monitor their controls, their information systems, and communication. These tend to affect risk across the board, at the big picture level.
Okay.
Then you have what are called control activities. These are the specific direct controls. Things like reconciling bank accounts, requiring approvals for purchases. These usually target risks at that more granular assertion level.
Can you give us a really clear example? Maybe a direct control versus an indirect control, something relatable.
Sure. A direct control is precise enough to tackle a specific risk. So let's say you manage your personal finances. A direct control would be meticulously reconciling your bank statement every month, line by line, and investigating every single difference.
Right, making sure the balance is exactly right.
Exactly. That directly hits the accuracy of your cash balance assertion. An indirect control, though, isn't precise enough on its own, but it supports the direct ones, like making sure your online banking has two-factor authentication.
Okay, that's good practice.
It is. It's a good general IT control. It helps secure the environment.
Yeah.
But it doesn't directly confirm if a specific transaction was recorded correctly. It just supports the processes that do.
That makes perfect sense. And speaking of IT, you mentioned information systems. Our source highlighted more focus on IT now. How does technology fit into controls and risk assessment today?
Well, IT systems generally are a huge benefit to internal control. That's important to say up front.
How so?
They can apply rules consistently, without human error. They do complex calculations in a flash, improve how quickly you get data, make it more accurate. They can even make it harder for people to bypass controls.
Okay, sounds good.
However, and this is the crucial bit, an IT system is only ever as good as the controls supporting it. So auditors now really have to understand how the company processes information using IT, how data flows into the financial reports, and critically, they need to assess the risks of using IT itself.
Like what kind of risks?
Things like unauthorized access, data getting corrupted, inappropriate changes to systems or data.
Right.
And they need to look at the company's general IT controls, the safeguards around access, changes, operations that mitigate those IT-specific risks.
So it's not just, do they have computers? It's, are the computer systems controlled properly?
Exactly. It's the controls around the tech. Our force also mentioned manual versus automated controls.
Right. What's the difference there in terms of reliability?
Generally, automated controls are seen as more reliable. Why? Because they perform consistently as programmed. But they don't forget. They don't have a bad day. They aren't easily bypassed.
Like a password check.
Perfect example. If you enter the wrong password, the system just blocks access consistently. Or think of an automated ordering system that stops new orders if a customer is way overdue on payments. It just follows the rule.
Makes sense.
Manual controls, like a manager having to physically sign off on every single purchase request. Well, they're more open to human error, simple oversight, or even someone deliberately overriding the process.
Okay. And what if an auditor looks at the controls and decides, you know what, I'm not going to test if these are actually working effectively? What happens then?
Good question. ISA 315 revised is very clear on this. If the auditor decides not to test the operating effectiveness of controls for a certain area, then the risk of material misstatement for that area is basically treated as being the same as the inherent risk.
So they assume the controls don't work for assessment purposes.
Pretty much. They're saying, I'm not placing any reliance on these controls to reduce the risk, so I have to assume the risk is just the raw inherent risk. And that usually means they have to do a lot more direct testing themselves to get comfortable.
Right. More legwork for the auditor. Okay, so we've got inherent risk, the raw vulnerability. Control risk, the chance the company's safeguards fail. Together, that's the risk of material misstatement. What about that third piece of the equation, detection risk?
Detection risk. This one's different. It's the risk that the procedures the auditor themselves perform, their own tests, their checks, will actually fail to spot a misstatement that does exist and could be material.
So this is the auditor's risk of missing something.
Exactly. And this is absolutely crucial because it's the only risk component that's directly under the auditor's control. Inherent risk and control risk. They belong to the client, their business, their systems. Detection risk is all about the auditor's own work. How good are their procedures? How much testing do they do? And just to be clear, detection risk is not considered part of the risk of material misstatement itself. It's separate. It's the auditor's risk of not finding that misstatement.
Okay, that's a key distinction. Now, our source mentions something new called a standback requirement. Sounds interesting, like taking a breath. What's that about?
It's pretty much exactly that, a mandatory pause for reflection. Once the auditor has done their work to understand the entity, identified the key accounts and transactions, done their initial risk assessments, they have to deliberately stand back
And do what?
and evaluate all the audit evidence they've gathered from those risk assessment procedures, looking at it holistically.
So it's like stepping away from the trees to see the whole forest, making sure the big picture hangs together.
Precisely. And throughout this entire process, remember, the auditor has to be applying professional skepticism.
Right, that critical mindset.
Always questioning, always challenging assumptions, being alert for anything that seems off or contradicts other evidence. The stand-back requirement also specifically pushes them to double-check. Have we actually identified all the significant risks? What about those material items we didn't initially flag as high risk? Looking at everything now, does that initial assessment still hold up?
So it's a final check for completeness and coherence. That sounds sensible. Now, this revised standard with all this depth, does it apply the same way to a tiny local business as it does to a massive multinational corporation? That's like a lot for a small company.
That's a really important point. The requirements are extensive, no doubt about it, especially if you're dealing with large, complex companies, maybe with really sophisticated IT setups. However, ISA 315, revised, explicitly includes the concept of scalability.
Scalability,
Meaning auditors can and should tailor their approach. They apply the same core principles, deep understanding, separate risk assessment, skepticism, but they adapt the extent of the work based on the entity's size and complexity. Simple business, simpler controls, potentially less extensive documentation needed, but the thinking process remains rigorous. So yes, it's adaptable.
Okay, good to know. Well, this has been a genuinely fascinating deep dive into ISA 315, revised 2019, and, well, the whole critical world of audit risk. We've really seen how understanding those inherent vulnerabilities, assessing the strength of internal controls, and factoring in the auditor's own detection methods all come together. It's quite a system.
It is. And what's really striking, I think, is that while this standard is written for auditors, the underlying ideas, identifying risk, thinking about inherent factors like complexity or uncertainty, evaluating safeguards, applying that skeptical mindset, these have such broad relevance, don't they?
Absolutely.
They're really valuable ways to think, valuable frameworks for making smarter, more critical decisions in, well, pretty much any area of your life,
Right.
way beyond just looking at financial statements.
So what does this mean for you listening right now? Maybe next time you encounter a new piece of information, could be a news report, a claim about a new gadget, even something complex like evaluating a job offer.
Yeah.
Try thinking like an auditor for a second. Ask yourself, what are the inherent vulnerabilities here? What could naturally go wrong or be misleading? Are there any reliable controls, any checks, balances, sources of verification you can look at? And what about your own detection procedures? What questions should you ask? What research should you do? How can you apply a healthy dose of skepticism to verify what you're seeing or hearing?
Yeah, using that structured way of thinking about risk, it can be incredibly clarifying. It helps you cut through the noise.
Definitely. And maybe think about the most significant risk you face in understanding something new or making a big choice. How would you approach that knowing you might need, as the standard says, more persuasive evidence?
Or how would you evaluate the underlying controls on the information itself, recognizing where there might be bias or uncertainty or just plain complexity clouding the issue?
Lots to think about. We hope this deep dive has given you some new tools, maybe some new lenses for your own mental toolbox. Until next time, keep digging, keep questioning, and stay well informed.